The Russell 2000 just smashed through 3,000 for the first time ever, yet Microsoft is down 20%. That split tells you exactly where your money is going right now. Tuesday, June 23, 2026. Like and subscribe for daily market updates. Today's agenda: the split screen, Fed policy shift, geopolitical oil truce, commodities and crypto pulse, SpaceX valuation crash, earnings and M&A Watchlist. Up next, Federal Reserve policy shift. Wall Street looks like a divided house today. On one side, America's smaller companies made history. The Russell 2000 closed above 3,000 for the very first time in its existence. That happened near 3004 after touching an intraday record of 3015 earlier Monday morning. This is huge because small firms usually struggle when rates stay high, but they are punching through now. On the other side, the technology giants that carried this market for 2 years are cracking hard. Alphabet dropped 5% on worries about its AI strategy. Amazon fell nearly 5 points too. Microsoft is down more than 20% from its peak, which technically puts it in a bear market right here and now. The S&P 500 slipped to around 7470, while the tech-heavy Nasdaq fell more than 1%. Underneath that surface noise was a violent rotation, money fleeing expensive technology names and hunting for value instead. Chipmakers tied to memory shortages like Micron, Intel, and AMD bucked this gloom because they have real demand right now. The fear gauge ticked up slightly but remains calm on the outside. It's just brittle calm. Government bond yields climbed too. The 10-year Treasury rose toward 4.5%, while the 2-year hit its highest level since early last year. Futures pointed lower again overnight, led by tech stocks. This isn't outright panic. It's a nervous reshuffle ahead of Thursday's big inflation report. That brings us to geopolitical oil truce. Here is the engine driving all of this market action right now. The Federal Reserve left its key interest rate unchanged last week in a range of 3.5% to 3.75%. But under new chair Kevin Warsh, the tone turned sharply in favor of higher rates, meaning they are leaning toward higher rates to crush inflation faster. The dot plot revealed a committee split right down the middle. 9 policymakers now pencil in at least one hike this year, while another 9 still see a hold or even a cut. A market that began 2026 betting on cuts now treats a rate increase by year-end as its base case, with a real chance of a move as soon as September. Why the alarm over prices? May's headline inflation ran at 4.2% over the past year, the hottest in 3 years. But here is the catch: most headlines skip. Strip out food and energy, and core rate was far calmer, 2.9%. Almost all heat came from an energy spike. So the real fight inside the Fed is whether this is a temporary oil shock that fades as Middle East cools or something stickier. Most economists still expect rates to sit unchanged through year-end despite hike chatter, which makes Thursday's main event decisive, the PCE report. Which leads to commodities and crypto pulse. The most significant positive development from months of Middle East conflict is a major diplomatic breakthrough. The United States and Iran have agreed to a roadmap for peace within 60 days, granting Tehran immediate permission to resume global oil sales. This signals the reopening of the Strait of Hormuz, a narrow shipping lane carrying nearly 1/5 of world supply. Millions of barrels now flow through this choke point again, following Treasury Secretary Scott Bessent's confirmation that Iran committed to free transit and allowing international nuclear inspectors back into its facilities. Consequently, crude prices have dropped sharply as markets price out fears of prolonged blockades. However, investors must recognize this remains a fragile truce rather than finished peace. Tehran warns the strait will never fully return to pre-war capacity, while pushing back against fresh restrictions on its nuclear program. While war premiums drain from futures, underlying danger persists. Any breakdown could spike prices overnight and hand the Federal Reserve new inflation problems, as energy costs caused most damage in last month's economic report. Meanwhile, Russia faces an increasing squeeze as global stocks plunged more than 4% Monday due to stalled Ukraine negotiations, while cheaper Iranian oil erodes Russian export revenue. This forces Moscow to lower barrel prices just to maintain volume, hurting hard currency earnings and altering global political borrowed money across Eurasia. For investors, this creates a volatile environment where short-term relief masks long-term structural risks that could destabilize energy costs again if diplomatic tensions flare unexpectedly in the coming weeks. Here's SpaceX valuation crash. To commodities, gold hovers near $4,150 an ounce, slipping slightly lower on Tuesday as rate hike expectations and a strong dollar outweighs safe haven demand. It remains well below its January record high. Silver sits around $66 after a rough week, while U.S. crude trades at roughly $74 and Brent near $78, both close to three-month lows. Goldman Sachs is trimming forecasts as Gulf supply returns online, helping lower global costs now. However, stepping back from daily noise reveals a sturdier story in metals. Central banks continue stacking gold, purchasing more than 200 tons alone in the first quarter. China has added for 18 months straight, with record shares stating plans to buy more. This is essentially a debasement trade, a bet that giant government deficits mean hard assets hold value better than paper money. Now, regarding crypto, Bitcoin trades around $63,000, down roughly half from its October peak near $126,000, while Ethereum sits at approximately $1,750. The driver is not a specific crypto scare, but the same macro vice squeezing everything: higher interest rates, and a strong dollar pull money out of risky bets, where crypto represents the riskiest corner. Funds allowing everyday investors to hold Bitcoin have bled billions over recent weeks as large players head for exits. On to earnings and M&A Watchlist. The most dramatic single stock move currently unfolding is the spectacular collapse surrounding SpaceX's public valuation narrative, though it remains a private entity whose perceived worth has plummeted in market investor mood. Elon Musk's rocket company went to public attention with enormous hype, before sliding for its third straight day, down 16% on Monday alone, erasing roughly $600 billion of implied value within mere days. This sharp correction gave back about a quarter of its peak, while announcing a fresh $20 billion debt raise, which one well-known commentator put bluntly: SpaceX couldn't hold onto meme status anymore. It is the clearest sign that appetite for sky-high how expensive assets look relative to earnings is cooling fast across the tech sector right now, because investors are scared of high interest rates crushing growth stocks permanently, echoing the brutal 2000 dot-com crash where speculative fervor evaporated instantly when funding dried up. Second-order effects include a broader retreat from capital-intensive aerospace projects as lenders tighten credit lines for unprofitable ventures seeking massive expansion. Concrete investor implications suggest that any company relying on narrative-driven pricing rather than immediate cash flow generation faces an existential threat, forcing management teams to rate change toward profitability or face delisting risks similar to those seen in previous bear markets when available cash in the market vanished overnight. Now let's wrap up with today's summary and the two biggest events setting tone for second half of 2026 market performance ahead next week. The earnings landscape steepens sharply tonight as FedEx reports its latest quarterly results, offering investors an immediate barometer of global shipping velocity that directly dictates the trajectory of Thursday's critical inflation data. Simultaneously, memory chip heavyweight Micron lands Wednesday. While this sector is riding a potent AI-driven demand wave, shares are currently anchored at all-time highs. Traders remain on high alert for unpredictable price swings, bracing for an intraday swing as wide as 17% either way, given the stock's compressed technical range and heavy institutional ownership near these peaks. Meanwhile, the merger and acquisition machine hums loudly with unprecedented vigor, because AbbVie successfully closed its acquisition of drugmaker Apogee for nearly $11 billion, a move that instantly sent its stock soaring almost 50% on renewed growth optimism. Additionally, building materials giant CRH is executing a cash takeover of Arcosa at $150 per share to consolidate regional infrastructure assets. This aggressive deal activity signals that M&A remains strong despite elevated interest rates, suggesting capital allocation has shifted from yield-chasing bonds towards strategic consolidation in undervalued industrial sectors. Historically, such fervor often precedes a broader market rotation, where available cash in the market dries up for small caps, while large cap acquirers absorb excess cash reserves to secure supply chains before the next rate hike cycle hits. For investors, this environment demands selective positioning. Avoid overexposure to single-name tech stocks at these how expensive assets look relative to earnings, and instead consider rotating into defensive industrials or companies with strong free cash flow conversion rates that can weather high-rate environments while benefiting from consolidation trends. The market mood remains tense as investors rotate out of crowded tech giants and into value stocks, with the Russell 2000 hitting a record high, while megacap technology firms face pressure. A split in Federal Reserve expectations has made Thursday's PCE inflation report critical for determining tomorrow morning's direction. Hot data could lock in rate hikes that drag down stretched leaders, but cooler numbers might allow rates to stabilize and fuel next week's rally. Meanwhile, the SpaceX collapse highlights a rapid shift from hype back to financial reality among investors today. Thanks for watching Market Pulse Daily.